Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, February 4th, 2016. It's about quarter after 10 a.m. Eastern Time as I'm doing this video. I wanted to follow up. I know there's been a lot of interest in GDX. I've been trading GDX in miners lately. Right now, we don't have any official trade ideas on the site. We were stopped out of the most recent dust trade yesterday, and I did a video update which was posted in the trading room last night. I can't. Maybe I put that on the front page. Front page, yeah. Either way, this is just a sort of follow-up. We actually now was looking for a pullback, which I still am. We gapped up, had a nice strong move, but right into that. I've been harping on this downtrend line for years now, really. This is a trend line off the 2012 highs. If you didn't watch that video, it was discussed in there, and it's been touched on many times. So here we are. We're at a very solid resistance level. Nothing is 100% in trading, but I would put very strong odds, even if we get an intraday pierce. I mean, the trend line can be adjusted here or there, but to me, that's a perfect tag. So I mentioned last night going back into dust before the close, a small position, and I've added that to a pretty hefty position here. So far, it's what turned out to be, I think it was 858 or so in GDX or dust, I'm sorry, and we're right around where we're currently at. So I'm doing this video while dust and GDX are so far now. The day is far from over, but so far at their highs in GDX for the day, lows in dust, and I just wanted to get this out there. So what I've done is taken that up to now a sizable position. I talk a lot about managing overnight risk, and that's one reason I won't. Overall, I'm keep trading this market pretty lightly. Although intraday, I don't mind going in and hitting an individual stock or ETF hard if I have a lot of focus on it. I call that day trade size position. It's a big difference on what I'll take home overnight because you can't control gaps, and gaps can work for or against you. So trading's all about managing risk. So anyways, and I wanted to talk about that a little bit. I'll get into that, but here's the chart on GDX, and here's what I'm looking at here. I've moved this over. This is that. If we look at, let's color code these. I know that this chart may look busy to those that, because I have a lot of lines on here, but what I'll do is color these lines yellow, which represent a large bullish falling wedge pattern. And this, like I said, this downtrend line goes back all the way to 2012. So now we're at that. From the look of these bullish falling wedge patterns, typically wedges break out somewhere around 70% to the apex of the wedge, which, if that's the case, to break out here would be a little early. It's possible. Again, anything is possible. These lines here confirm bullish divergence beneath that wedge. They do speak to the fact that, an impending trend change is likely. Now, we can go in and make another higher low on the MACD and the RSI. That's certainly a possibility. It's hard to look out too far. Right now, what I'm looking at, even if we manage to punch a little higher today, I think at the very least in the next day or so, we're going to come back to this blue line. GDX has just had, one heck of a monster near vertical run up to that level. And as I often state, the initial tag of resistance from above is typically followed by a reaction. So that's just trading. You put the odds in your favor. If we punch much through here, I'm not going to allow my position to go up that high. Especially right now, I have a sizable position on which I'll take off some of that before the close. And if we get the pullback I'm looking for, any bearish confirmation, I'll probably hold out and maybe look for a move back down to this 1538 level which would be a backfill of today's gap. Really, is what you're looking at. The gap between yesterday's close and today's open. Gaps are like magnets, very often being backfilled. So that's it. That's the near-term outlook, and just to kind of draw it out here, the possibility very easily exists that this wedge may need a little more time to form, maybe a deeper pullback. I really doubt, although anything is possible, another new low. Once again, anything is possible, although that's not my current expectation. If I had to venture my best guess, it would be maybe a little sideways action here, chop around for a few weeks, I'm probably drawing it out a couple months here, but and then ultimately breaking above this pattern, and there's the next target. So that's the near-term outlook. Is yes, still looking for a pullback. Just because I didn't get it the other day, that doesn't mean one's not coming. And I'm trying to be as objective as I can looking at these charts. Obviously, my longer-term outlook continues to remains bullish. That's the way I should have said that. My outlook remains bullish longer term. And even intermediate term, just looking for a short-term pullback here. And if we don't get it, then stop out, let it go, and then wait for the next objective long entry, next chance to buy back in GDX or short entry, whatever comes. But now the trend is up so far. So any trades or counter trend trades if they're short. So those should be quick, nimble trades, and only done by aggressive traders. All right. Let's now talk real quick about something that I think is very important. I know a lot of you trade the miners. I get the comments in my comment forum in the trading room. And why not? The miners there's fewer sectors out there where you can make as much money in short order, but that's a double-edged sword. There's very few sectors out there where you can lose so much in such a short period of time. Let the last few days be a good example here. GDX was up over 5% yesterday. It's up another 5. So this is what we're looking at, a 11% or so move in just 2 days in GDX. Now some of you might say, "Oh my gosh, that's just unheard of." I've traded GDX for many years, and although that's not a typical daily or 2-day move, it is far from anything that's out of the norm of GDX when GDX starts moving. Here's a period back here. Let's get that darn trend line out of the way. Here's move that one. 2-day slide in GDX. It was 12% right there. And that's me just eyeballing the chart. I'm not trying. You can go back anytime you want. So the move that we just saw is perfectly normal or perfectly well within the range of a 1-2-day move in GDX when this thing is moving. In other words, there's times it consolidates, but it's plagued with these rips and dips, and they're what I call unidirectional, almost straight up and then straight down. So where I'm going with all this, and those of you that traded it or have traded GDX don't need to be told this, but if you're on the right side of the trade, great. Very few ETFs, especially, that are going to make you such money in short order, and that goes the other way. So what I wanted to talk about is beta-adjusted position sizing. I've mentioned this term dozens, if not hundreds of times on the site. It's in the frequently asked questions, FAQ. Visit that. That's on the top menu of the site. Click on FAQ. And please, if you're new to trading or you're really just shocked from the size of the losses that you've incurred if you took the dust trade the other day and you didn't stop out when the trade hit the stop yesterday at on the 11 o'clock candlestick close. This is important, and all this says, I will not read through the entire thing right here, but it essentially says when you take a trade, you need to account for the volatility. And so you have GDX, there's a security, an ETF that can easily go up or down 5% in a day. So that is much more than almost any other sector out there, and a lot more than a lot of individual stocks. Add to that, when you're trading Dust or Nugget, I don't have to tell you, it's 3 times leverage. So now you're looking at 15% moves in a day, and 2-day moves that can be 30% or more. Again, great if you're on the right side of it. Horrible if you're on the wrong side of that trade and you're not managing your downside risk. So all I'm trying to tell you here is take a look at, when you trade a stock, don't just look at the price target and see dollar signs in your head. Oh, great, I could make this much or that much. Quantify what your dollar loss will be if your stop is hit. And when trading the miners, unfortunately, you have to allow wider stops. At least that's my take on them. If swing trading, if I'm looking for a, let's say, 30% move in GDX, I need to allow myself a 10% stop. Otherwise, with just the day-to-day volatility in these things, you probably get stopped out long before you hit that 30% target, unless you happen to really get on one of these unidirectional rips. So now trading Dust or Nugget, 30% upside in GDX is 90% upside. Well, theoretically, there's decay and all that. Depends on how long it gets there, but that's also a 30% downside risk. Now, some of you might say that's absolutely ludicrous. Who's going to risk 30% on a trade? It's all relative. Again, it's relative to the risk return ratio. If you're shooting for that, 90% return on a trade, and there's many trades on the right side of the chart that have had 90, 100+% returns, then you can allow yourself a 30% loss as long as you adjust your position size accordingly, position size. For example, if you normally trade 10,000 in the Qs, then really on an ETF like Dust or Nugget, you should be no more than 3,000, maybe $2,500 in that position, because if you might make that 30, 40, 50% if you catch the right move on it, and likewise you have to allow larger percentage stops, but it all comes back to dollar amounts. That's what's going to wipe you out. It's not you can afford a 20 or 30% loss on a trade if you only have a very small amount of your capital in there, and again, that small amount of capital might say, well, it's not worth it. Well, it is worth it if you're shooting for a 40, 50% return. All right, enough on that. I've beaten a dead horse there, but I think it's very, very important, especially if you're new to trading. And there's one other component to that as well. It's not just GDX. Take a look at the VIX. The VIX is, as most of you know, the volatility index. And when volatility spikes, it's typically during sell-offs. These are all these big spikes in the VIX. This is a 10-year history. Those are during sell-offs. Here's the bear market in 2008. These are corrections along the way. So what I'm getting at here, when you see volatility spiking, the day-to-day price swings on just about everything out there, the broad markets, QQQ, SPY, individual stocks, they're going to be a lot higher. Therefore, when volatility spikes, assuming that you're a seasoned trader, you're nimble, aggressive, and you're comfortable trading these markets. If you're not, best thing to do is step aside. If you are, keep that in mind, that your gain potential, especially during a bear market, I mean, goodness, you've seen it lately. 2, 3, even 5% intraday swings in the market are fairly common when the VIX gets up to these levels. So what you need to do to successfully trade it, especially swing trading it. I'm not talking day trading, but if you're going to be swing trading, which involves overnight risk, meaning your position can be gapped for or against any given day. A gap against you is going to hurt you. Same story. Adjust your position size down. If the market's trending back here, when you have low VIX, that's when the stock market was just trending up, and everybody thought it would go on forever. And that's fine to have if your average position size in the Qs is $10,000. Leave 10,000 in that position. However, with this additional volatility, if your trade is successful, you'll hit your profit target in a shorter period of time. But if stopped out, you're going to have a larger percentage loss. In other words, so you're looking at larger percentage gains and losses is what I'm trying to say. So just adjust your position size accordingly. Two other things, take a look if you would at all the frequently asked questions, because a lot of these are put to me all the time on the site. And please let me say this. I welcome questions. If you have any questions, ideally, if you can post it in the trading room, if you think others may benefit from that question, because 99% of the questions I have are answered. Other people have the same questions. Some people will ask them, some don't. So put it in there. If it's a question and you for whatever reason you'd rather not have that question answered publicly or viewed publicly, by all means, shoot me a personal message, private message using the trading room, the private message feature, or you can use a contact form. And there's times if it's a great question, I'll delete your personal information, any personal identifying information, and post that for others to see. But again, you can reach out to me that way. But a lot of questions, as I said, are already answered in here. And a couple of the ones that I wanted to harp on besides the beta adjusted position sizing is this one I get over and over and over. When you're trading these leveraged ETFs, please keep in consideration that 99% of the time, if you're swing trading or holding these for any more than a day or a couple days, the decay, especially in volatile sectors like biotechs, is a great example. We just closed out a multi-month biotech short yesterday on LABU. for over 80%, and most of that was due to the decay. The sector isn't down, that much. It's down quite a bit, but you can look at LABU compared to XBI, and you can see the difference. I mentioned in here there are times like take GDX for the last few weeks. It is possible, but very rare, and I talk about it here, that there are times where leveraged ETFs actually perform better than expected. In other words, the last few days, you would have done better than 3 times what GDX did due to that leverage. That only occurs when the market goes straight up when you're holding that thing. And that does happen once in a while, but you really got to get the timing right. That's why often, unless I'm trading for more than just a couple days, I'd rather short nugget than go long dust, as an example. Talk about that a lot. So, but the bottom line is, if you're, natural gas, there's a volatile one, any of those, if you're, day trading, those 3-time leverage ETFs are great. If you're going to swing trade it, just either buy the 1-time or short the 2 or 3-time leverage ETF in the opposite direction that you want to take the trade. So again, this is explained in detail there. It'll talk to you about how that leverage works, and how the leverage impacts an ETF and what that decay is. I often talk about. Let's see, there was one other thing that I think I wanted to talk about. Yeah, multiple price targets. Factor this in. Take a look. This is why I list multiple price targets. A very high percentage of the trades that I post hit that first target level. Sometimes that's where I'll book profits. I try to, if I'm in a trade, I don't take them all. I take the majority of trades. I'll share my thoughts where I think things are going. I'll often list what I call my preferred price target. And I think this helps people understand why I list these different price targets. And remember, my trading style isn't going to match everyone else's, so you need to have your own trading style. You might not, care to try to shoot for a 30-40% gain on some of these trades that I have. You might not want to ride out the volatility. You might want to book quick profits on the first targets. And if you do, keep in mind, when I list a suggested stop, unless I list multiple stops, sometimes I will, but if I have a trade, I will typically calculate that stop. That's the maximum suggested stop. It's based on the longest price target or my preferred price target at the time. So, if you're only shooting for the first trade, and again, I use just a rule of thumb. I like to use at least a 3-to-1 risk-return ratio. That's usually where I calculate my trades, and then I'll set the stops based on support and resistance levels that come in around that 3-to-1 RR. But everybody needs to really set their stops that are commensurate with their own risk tolerance and trading style. But again, this talks a little bit about why I use multiple targets and different ways to trade those multiple price targets. Okay, this has been Randy Finney with Right Side of the Chart. And as I mentioned, if you have any questions at all, don't hesitate to reach out to me either in the trading room or by private message. Okay, have a great day.